Imagine it is October of 1930. I want you to picture a grain farmer in rural Nebraska. I want you to picture a man who has worked the same land for 30 years, a man who sold his harvest a few weeks earlier and deposited the proceeds into the local bank because that was the responsible thing to do. He did not speculate. He did not gamble. He did not do anything clever. He simply trusted the system. Then one Tuesday morning he drove into town to pull out a small amount for winter supplies, and he found a line outside the bank. The doors locked, a handwritten sign on the glass, and the money he thought he owned trapped behind a vault door he would never open again. That is not fiction. That is not an exaggerated parable. That is what banking failure looks like when it stops being an abstract headline and starts becoming your life. Most people remember 1929 as a stock market story. They remember the crash, they remember the panic, they remember the photographs, but the deeper damage did not come from stocks. It came from banks. It came from ordinary people who believed that money in a bank was the same as money in their hand, and then discovered too late that those two things are not the same at all. That difference is the entire subject, because once you understand what a bank actually is, you stop treating it like a vault and start treating it like what it really is, a counterparty. And counterparties can fail. That is the first thing I would want you to understand. When you deposit money into a bank, you do not place your money in a private little box with your name on it. You are not renting a section of a vault where your exact dollars sit patiently waiting for your return. You are entering into a contract. You hand the bank cash. In exchange, the bank gives you a claim. The cash becomes part of the bank's balance sheet. The promise becomes yours. That sounds harmless in normal times, because in normal times access feels exactly like ownership. You swipe the card, the transfer clears, the cash comes out of the machine. The illusion works so well that people stop seeing it as an illusion, but access is not ownership. Access is permission inside a functioning system. Ownership is control outside the system. Those are very different things. And they only look identical as long as confidence holds. That is what 1929 and the years that followed exposed with terrible clarity. In those days, the United States had tens of thousands of commercial banks operating under the same broad architecture that still defines modern banking, fractional reserve banking. The idea is simple and elegant and also fragile. A depositor places money in the bank. The bank keeps a portion on hand and lends the rest out. The person who borrows spends it. The person who receives it deposits it somewhere else. That bank keeps a portion and lends the rest out again. One pool of real cash turns into a much larger web of claims and credit. In calm conditions, this feels like genius. It lubricates the economy. It expands activity. It creates growth. But the beauty of the system depends on one assumption, that not everybody asks for their money back at the same time. The moment enough people do, the machine reveals its weakness. The money is not sitting there. It has been lent. The assets are long-term. The liabilities are immediate. That mismatch is not a bug on the edge of the system. It is built into the heart of it. And when confidence cracks, that mismatch becomes fatal. That is exactly what happened in the early 1930s. A large failure triggers fear. Fear triggers withdrawals. Withdrawals force liquidation. Liquidation creates losses. Losses trigger more fear. One bank failure teaches depositors at the next bank to run faster. Suddenly, the thing collapses under its own design. Thousands of banks failed. Deposits were erased, savings vanished, and the people who paid the price were not reckless speculators. In many cases, they were the most responsible people in the room. They had done exactly what they were told to do. They had worked, saved, deposited, and trusted. That is why I always tell people the most dangerous financial losses are often the ones that arrive wearing the costume of safety. The stock market announces its danger loudly. A bank account whispers safety right up until the door is locked. Now, after the Depression, the United States created the FDIC, and that changed the psychology of banking for generations. It restored confidence. It told depositors that even if the bank failed, the government would reimburse them up to a limit. That was enough to stop many runs before they started. And confidence in banking is half the architecture. But confidence is not the same as elimination of risk. It is the management of risk perception. That distinction matters. Deposit insurance is real. It is helpful. It has reduced the probability of the ordinary depositor being wiped out in the exact old-fashioned way. But it does not abolish the underlying fragility. It overlays it with a backstop that has its own conditions, limits, and political realities. Most people do not think in those terms. They think in a much simpler way. They think that if the bank fails, the government pays, therefore the money is safe. That is an understandable conclusion. it is also an incomplete one. The insurance fund itself is finite. It is designed for isolated failures, not for the entire system breaking at once. It works beautifully when one institution stumbles and the rest of the machine remains standing. It becomes a very different conversation when multiple institutions are hit at the same time, when liquidity disappears, when fear spreads faster than policymakers can contain it, and when the public starts asking for certainty from a system built on leverage and confidence. Then the question becomes not whether you are insured in theory, but how the system will actually be stabilized in practice. That is where history becomes useful again. When Silicon Valley Bank failed, uninsured depositors were made whole, but that did not happen because there is some eternal, universal guarantee floating over every dollar in every account. It happened because policymakers judged the situation dangerous enough to justify intervention. That is a discretionary response. It is not the same thing as a timeless law of nature. And when your financial safety depends on discretion, politics, and emergency judgment, you are no longer standing on bedrock. You are standing on a decision someone else may or may not make under pressure. That is not the kind of certainty I like. Then you have the Cyprus example, which I think every serious saver should understand because it stripped away the last bit of romanticism around the word deposit. In 2013, depositors with balances above the insured limit saw a large portion of their funds converted into bank equity to recapitalize the institution. That is what a bail-in means. Instead of taxpayers taking the first hit, creditors and depositors inside the institution absorbed the damage. People hear that and imagine a strange foreign exception. I hear it and think of an incentive structure. Governments dislike politically visible bailouts. Regulators prefer solutions that keep the system standing while distributing losses in a way the public struggles to understand in real time. That is what modern crisis management tends to do. The labels are new, the instinct is old. Stabilize the machine, distribute the pain, manage the optics. Once you see that clearly, the practical question becomes obvious. If a bank is not a vault, if deposit insurance has limits, if bail-ins exist as a concept, if access can freeze during stress, then where should you store cash when the point is not return but resilience? There is no perfect answer. That is the second thing I would want you to understand. People want one clean solution because certainty is emotionally satisfying. Real life does not offer that luxury. Every store of liquidity comes with a trade-off. And the trade-offs only become visible when you force yourself to ask what kind of crisis you are actually preparing for. Start with physical cash. Physical cash has one beautiful quality. It is outside the immediate electronic reach of the banking system. It cannot be digitally frozen. It cannot be bailed in. It does not depend on a bank reopening on Monday morning. If your concern is short-term bank inaccessibility in a deflationary panic, physical cash has obvious value. During the Great Depression, cash gained purchasing power because prices fell. The person holding currency while assets collapsed had optionality. But cash also has obvious weaknesses. It earns nothing, it can be stolen, it can burn. And if the crisis you get is not deflationary but inflationary, then cash becomes a melting cube in your hand. People who confuse crisis with a single universal condition make bad decisions. A banking panic and an inflationary debasement are not the same animal. The tool that protects you from one may damage you in the other. Then there are Treasury securities. Treasuries are a very different proposition. They are not a claim on a private bank. They are a direct obligation of the United States government. If your problem is private banking fragility inside a dollar system, Treasuries sit in a stronger position than an ordinary deposit. They are central to the machinery of global finance itself that matters. Held properly, they reduce bank counterparty exposure. But even here there are trade-offs. If you hold Treasuries through an intermediary, then the intermediary matters. If you hold them directly, accessibility and convenience may suffer. If you lock duration too aggressively and inflation becomes the problem, you may preserve nominal safety while sacrificing real purchasing power. Again, no perfect answer, only trade-offs. Money market funds sit in another interesting zone. People treat them as cash equivalents because they are liquid, familiar, and usually stable. In normal times, they often behave that way, but they are not bank deposits. They are securities vehicles holding short-term instruments under stress. They can wobble. We have seen that. When people say cash equivalent, they often mean psychologically equivalent. The law does not always agree. Precious metals raise a different set of issues. Gold has thousands of years of history as a store of value outside the credit structure that deserves respect. It cannot be printed. It is no one's liability. If your concern is long-term currency debasement or distrust in financial claims, gold answers that concern in a way a digital bank balance never can, but gold is not free from political risk or practical problems. It must be stored, it can be confiscated or restricted, it can be hard to use in a short-term functional emergency, and it can underperform for very long stretches if your timing and purpose are confused. Gold is not magic. It is a tool. If you do not know the problem you are solving, any tool becomes a superstition. Foreign accounts and foreign currencies can add jurisdictional diversification. That can be sensible in principle. A single government, a single banking regime, and a single currency are a concentrated bet, whether people admit it or not. Diversifying that concentration has logic, but it also brings reporting burdens, legal complexity, currency risk, and a false sense of sophistication among people who mistake distance for safety. Geography is not safety by itself. It is only useful when paired with understanding. Real assets are another category, entirely land-productive property, things with utility in the physical world. They are not liquid, but they are not merely digital promises either. In inflationary eras, real assets can preserve value far better than nominal claims. In deflationary contractions, however, they can become illiquid burdens if financing disappears and buyers vanish. That is why I dislike single-answer thinking in matters of preservation. What survives one storm may sink in another, so what does a rational person do? A rational person starts with structure, not prediction. That is where the real lesson of 1929 lives. The lesson is not that every bank will fail. The lesson is not that you should live in fear. The lesson is not that every dollar should be shoved under a mattress or turned into gold coins. The lesson is that systems built on leverage, confidence, and maturity mismatch remain fragile by design, and any intelligent saver should respect that fragility even while using the system. Respect does not mean panic. It means optionality. It means not placing all trust in one mechanism. It means understanding that convenience is not the same thing as safety. It means recognizing that the biggest financial danger often lies in the place society has taught you not to question. A prudent person can keep operating liquidity in the banking system because life requires it. Bills must be paid, transfers must happen. The financial world still runs through those rails, but a prudent person also asks harder questions. How much of my wealth is merely a bank liability? How much immediate cash do I have access to if digital rails freeze for a week? How much of my liquidity depends on one institution? How much of my supposed diversification still lives inside the same system under different labels? How much of my security is merely confidence borrowed from yesterday's calm? Those are adult questions. Most people never ask them until stress forces the issue. That is why crises always feel like surprises to the majority. The mechanism was sitting in plain sight the whole time. People simply preferred the emotional comfort of not examining it too closely. The system is very good at encouraging that preference. It gives you speed, it gives you convenience, it gives you rewards, apps, seamless transfers, and a polished sense that everything is under control. And in exchange, it asks for trust. The problem with trust is not that it is always misplaced. The problem is that it is usually unexamined. If you go back through modern financial history, the same pattern keeps repeating. In every era, the public is given a modern explanation for why this time the machinery is safe enough to stop worrying about. In every era, there is some truth in that explanation. The system usually is stronger than before. The tools usually are better than before. The backstops usually are larger than before. And yet the underlying logic remains stubbornly familiar. Claims multiply faster than base money. Confidence holds everything together. When confidence breaks, the structure reveals its old bones. That is why I do not think about safety as a binary. I think about it in layers. Layer 1 is immediate access. Layer 2 is legal priority. Layer 3 is inflation survival. Layer 4 is jurisdictional resilience. Layer 5 is psychological readiness. Most people put everything into the first layer and assume the rest will somehow be handled by the authorities if necessary. History does not reward that kind of laziness. The people who come through financial shocks best are rarely prophets. They are rarely the loudest pessimists. They are simply the ones who built room to maneuver before the crowd discovered it wanted the same thing all at once. That is the third thing I would want you to remember. The goal is not to predict the exact shape of the next crisis. The goal is to avoid being fully trapped by any one shape of it. If you prepare only for deflation, inflation can ruin you. If you prepare only for inflation, a liquidity freeze can hurt you. If you prepare only for bank failure, sovereign stress can surprise you. If you prepare only for macro theory and ignore legal mechanics, paperwork and access rules can blindside you. Preparation is not romance. It is distribution. Distribute your trust. Distribute your exposure. Distribute your dependence. That is how you reduce fragility in a fragile world. And if you still think all this sounds a little too cautious, go back to Harold in Nebraska. He was not stupid. He was not reckless. He simply believed the common belief of his time that money in a bank was safe because banks existed, because the building looked permanent, because the town trusted it, because no one had taught him to examine the plumbing underneath the promise. Then one morning he met the plumbing. That is what crisis does. It turns invisible structure into visible pain. You do not have to live in fear of that. You do have to respect it. Banks are not evil. They are machines. They create credit. They support commerce. They make modern life possible. But machines have design limits, and when pressure exceeds those limits, sentiment, slogans, and public confidence do not change the mathematics. Only structure does. That is why I always come back to the same quiet principle. Do not confuse familiarity with safety. Do not confuse access with ownership. Do not confuse insurance with invulnerability, and do not wait until the line forms outside the bank to ask where your money actually is. By then, the question has become expensive.